Welcome to the Retirement Evolved podcast with certified financial fiduciary Adam Bruno.
And away we go with episode 53. Gosh, 53 episodes, Lauren. You know what? I'm glad to be back with you. So let's get things rolling the right way. This is the Retirement Evolved podcast with Adam and Lauren. So that's Evolution Retirement Services and Evolution Wealth Management. We're here in Fort Myers, Florida. I was in Arizona last week and I thought I was going to die. And they all say, it's a dry heat. It's a dry heat. I don't know about that. But you can follow us on the podcast. You can also go to our website, taxfreefortmyers.com, download a copy of the book. Everything is absolutely free on that landing page website. Then we have our regular page, evolutionretirementservices.com, where you can learn more about us. But basically, in a nutshell, we do these podcasts to serve the community and make sure that people have correct information about retirement and some great strategies they can use and put into place right away to make retirement even better.
Love it. You know, I wanted to just talk about a couple events that we have coming up. We do have our pickleball event. It's our second one this year. It'll be held at the Omni Health Club. That's right over by the Broadway Palm Dinner Theater, Adam. And you guys can actually come in, and it's for beginners. It's for everybody.
And there's a pickleball. There's a pickleball pro there as well. As I understand it, that will be joining us for the tournament. Really young guy. I thought, the older crowd played pickleball, but he's like 23 years old.
Yeah,
he's like number 30.
Yeah, 30 in the world or something. Something's crazy. We also have our Evolution Christmas party that we do every year, which is post-Christmas. That'll be on January 8th this year. It's going to be a great event. It'll be at the Broadway Palm Dinner Theater. There's going to be obviously a buffet-style dinner and a show, The Buddy Holly Story, which will be really great. Some 50s-style music, and we're just looking forward to seeing everyone.
Buddy Holly.
Yeah. So, Adam, let's dive right into this.
Okay.
Today, we're going to be talking about HSAs, health savings accounts. Adam, what exactly is an HSA, and who is eligible to open one?
I'm so glad we're covering this, Lauren. This is a very important topic. HSA, or health savings account, not to be confused with anything that you could get through work that's you have to use by the end of the year, right? This HSA is just set it in there, and it's actually a tax advantage savings account. It's designed for individuals with, high deductible health plans. So your deductible is $5,000 a year or $2,000 a year. And to qualify, you need to be enrolled and not be claimed as a dependent on someone else's tax return and not be enrolled in Medicare.
Okay, great. Thank you. Can you explain the triple tax benefits of an HSA and how they help build your wealth?
Yeah, it's really interesting. The triple tax benefits kind of make HSAs very unique. First of all, tax deductible contributions are going to reduce, obviously, your taxable income, and that saves you money up front. But it's also tax-free growth, which allows the money inside the HSA to grow without being taxed on interest, dividends, capital gains. And then when you withdraw for qualified medical expenses, it's also tax-free, which means you don't pay taxes when you use the funds for health-related costs. So this is where we get the idea that it's a triple advantage type plan. And it can really help you build significant wealth over time because you're not limited inside the HSA on what you can invest in. The other nice thing about it is you can if you buy Band-Aids or whatever you could buy that would be considered a health cost, you can cut yourself a check for it retroactively.
That's amazing.
Tax-free. Yeah, it's pretty neat.
It's a great little plan. How can an HSA be a game changer for retirement planning?
Well, an HSA can be versatile when we talk about what we can use it for during retirement. You can use HSA funds tax-free for medical expenses, like we just said, and that's at any age. But after age 65, you can use them for non-medical expenses too. So the withdrawals are taxed like a traditional IRA. It kind of provides a way to save specifically for healthcare costs, which, as we know, in retirement, those are significant expenses. And it also offers you some flexibility for other needs that you might have.
Are there any strategies to maximize HSA contributions, and especially for those that are nearing retirement, since we do deal with mostly retirees?
Yes. First, contribute the maximum amount allowed by the IRS each year. If you're 55 or older, you can make an additional catch-up contribution. And also, if you have an employer that offers contributions to the HSA, make sure that you take full advantage of that benefit. The key is to maximize contributions early, invest the funds to benefit from that tax-free growth. So if you have an employer that's matching any contributions, that's so important because again, your employer is basically contributing to your triple threat retirement tool that you have now.
How can investing in an HSA funds be a smart move, and what investment strategies should people consider?
Well, investing in HSA funds allow the money in there to grow tax-free over time, much like a 401k or an IRA, because you're getting the tax deferral now. So it's a great strategy if you don't need to use the funds for immediate expenses. So consider a diversified portfolio based on your risk tolerance and time horizon. So that means, obviously if you're younger, you want to invest a little bit more aggressively because you have plenty of time before you're going to retire. And then those of us that are close to retirement, you may want to back off and have more of a conservative mix of investments within there.
Do you think, I have a question, this really applies to more somebody like me, I guess, but the HSA funds, will they roll over into the next year? Is that something that's correct. So you can use that. It just keeps going.
It's like having a tax-free investment account.
Okay, gotcha.
That's really what it is. So you can obviously inside the HSA, savings account. Let's use that word. If you wanted to put it in some sort of a fixed option inside of the HSA and just collect your 5% interest, then it'll just keep compounding and growing over time.
Gotcha. Okay, so this kind of correlates with that. What types of investment options are typically available for HSA funds?
Well, investment options for HSA funds vary, by custodian. So by, Schwab, Fidelity, whoever's holding the money. But it can include mutual funds, index funds, ETFs, stocks, bonds, and even some custodians offer target date funds, or we like to call them robo-advisor services, to help you manage those investments. So when you look at that, it's important to review the fees inside of the investment options and the account minimums when choosing a custodian. So if you need to have a certain threshold of money before you can move it to a custodian. So for example, there might be a custodian that says you have to have at least $10,000 in there. It depends. That varies greatly between custodians.
So just to make sure that you're reviewing all those options and those fees.
Well, and I think it's important to obviously do some research, every year, at least revisit it once a year, at least if you're not going to look at it quarter by quarter. Some people obviously are more in the weeds and they want to see exactly what's going on with it, every quarter. Some people are like, oh, I wonder how that did this year. And they look at it once a year. It really doesn't matter if you're younger, because you're building that up over time.
Right. What's a common mistake people make when using their HSA, and maybe some things about how they can avoid that?
Oh, I'm so glad you asked that, Lauren. That's very important. So one of the common mistakes is treating the HSA like a regular savings account and not investing the funds. So if you don't need the money for immediate medical expenses, you want to invest that money for long-term growth. And then another mistake is failing to keep receipts for, any of your medical expenses that you have, because you can reimburse yourself at any time tax-free in the future if you have documentation from that medical expense.
Wow. That's interesting. Very interesting. I'm bad at keeping receipts though,
Yeah, I know. And that's why I go back to when you call it a savings account. I mean, yeah, I guess you could do that, but you could also do that at the bank. I mean, if you're going to,
you might as well
take some risk with it. That's right. Yeah.
Are there any expenses that people commonly think are covered by HSAs, but actually aren't?
Ooh, you're hitting me with all the good ones.
I'm trying.
So many people are going to assume that all health related expenses qualify. But of course, that's not the case. For example, cosmetic procedures would not be considered something that would qualify. General health items like toothpaste or soap or health club memberships, those aren't eligible.
That seems unfair.
It is, and it's crucial because the IRS kind of releases a guideline every year, or if they forget it, it's still the same as last year. But they give you guidelines. You can also consult, a financial advisor to know what qualifies, but it's been challenging to find other firms that are even talking about HSAs, or other advisors that even talk about this, which is why it's so important that you hear about it today, because it is, from an investment standpoint, everybody always slams the table and preaches Roth. Well, this is kind of the best of all worlds, right? Because even if you put the money in tax deferred, you know that it's going to come out tax free.
Yeah, that's incredible. This goes into our next segment here, but how can someone decide whether to prioritize an HSA over other retirement accounts like a 401k or an IRA?
It all comes down to, I think, the match. If your employer offers a 401k match, you definitely want to contribute enough to get the full match first, because it is free air quotations, free money, right? Not that you won't have to pay the tax on it later, but let's not get into that today. So after that, you want to consider maxing out the HSA because of its triple tax benefits. So for example, if your employer is matching you 6%, you should put 6% in. And if your goal was to save 10% this year, put the other 4% into the HSA. Or if you really want to, if you want to do something different, we always say too, you can put the 4% in a Roth, but just remember, you're paying taxes on that money. If you put it in the HSA, you're not.
But like you said, it's tax deferred.
Correct. So the HSA is tax deferred in a sense that you put the $4,000 in there, you don't have to pay any taxes on that money. Just like you didn't have to pay any money on the 6% that you put in the 401k. The difference is though, while this money is growing, it's growing tax-free as long as when you take it out, you use it for medical expenses.
Oh,
a lot of people,
that makes it much more simple.
And a lot of people save it up, and their whole Medicare costs are covered then. So if they have to buy a supplement later on or an Advantage plan, they just use the HSA to cover that.
Okay, and can you combine an HSA with an FSA, which is a flexible spending account?
No, that's the idea where the FSA, you can't have a standard FSA and an HSA. But there are exceptions like limit purpose FSA that only covers dental and vision expenses. Unlike FSAs, HSAs do not have a use it or lose it rule. Remember, that's what we were talking about earlier. There's no limitations on, well, you have to use it this year, right? So HSAs don't have that limitation when FSAs generally do.
Okay, gotcha. That definitely makes more sense to me then. What are some advanced strategies for using an HSA to its fullest potential?
Advanced strategies are going to include...
Which we just talked about, kind of.
Right. It's going to include using the HSA to cover Medicare premiums in retirement. We just talked about that. Obviously, saving your receipts for future tax reimbursements. And really the idea is beyond all that you treat the HSA as a supplemental type of retirement investment, right? Because the idea is medical costs, we know, increase greatly over time. So now imagine if you're, 30 years old, listen to this, or even if you're 60 years old, what are those costs going to look like 10 years from now? You could argue that they're probably going to be more. So having the HSA, the way I like to look at it is, we've been able to compound over years and years, and that's helped us keep up with the increase in medical costs. So now when we need to dip into the HSA, we're going to be fine. We don't need to dip into other investments. And
I read that some people can use it to pay for like long-term care insurance premiums.
That's correct. It's a medical cost. Long-term care is a medical cost.
And it can also be tax-free up to certain limits.
Correct.
Okay.
Well, it should be, we can do some research on this, but if you're using the HSA for the long-term care costs, that should be considered.
It's for insurance premiums.
Okay. Yeah. For insurance premiums. Yes, that is also correct. Okay. You know how I feel about long-term care insurance though, for anybody over the age of 55. You might as well just give it up and, anyway. Okay.
All right.
Moving on.
So, we were just talking about, using this to cover Medicare premiums. Are there benefits to keeping an HSA even after you've enrolled in Medicare?
Well, yes, because we already discussed this. You can use your Medicare Part B premiums. That can pay for them. I'm sorry, not your Medicare, your Medicare supplements.
Medicare premiums, deductibles.
Yeah, you can use that money to retroactively pay for it if you want, or you can set it. A lot of people have an HSA and they'll have a debit card or something. You can have the premiums just deducted from the HSA account. So I would say there are definitely benefits, because if you go into it with this idea that, hey, this is specifically for healthcare, it's a different asset class in my investments, so I know that my healthcare is taken care of. Well, if you end up with extra money, sure. I mean, it's extra tax-free money you can pay yourself if you wanted to.
We've been doing all this Q&A, and I want you to give us a scenario where an HSA can be advantageous for someone planning an early retirement.
So let's say that you've done very well and you want to retire early. Let's say that you have, you've managed to accumulate $150,000 in your HSA, right? Now you're 61 years old and you decide to retire early. Heck, let's just say 60. For the next 5 years, you might be in need of medical insurance until you reach Medicare age. Well, look what you just have to deal with now. You have $150,000 that you can use towards. Now, is it going to cost you that much? Obviously, probably not, but you have $150,000 that you can use to insure yourself until you're ready to go on Medicare itself. So that's a perfect example because, that's something that a lot of us, behind this microphone always see. You see people that are 62 and they say, that's it, I've had enough, but I'm only working for the benefits because I want to last till I'm 65.
Right.
Well, there are lots of options to get around that. And an HSA will help you fund those options.
Which is great. And you get the tax-free growth like we talked about earlier.
Right. It's just such a good tool. Again, if you use it saying, okay, if I just put, this much money away every month inside my HSA, by the time I retire, anything medical related, I can take care of with this account. I don't have to touch my other investments.
Yeah, that's incredible. It really is. Well, this has been awesome, Adam. I appreciate it. But before we wrap this up, what would you say is like the key takeaway you'd like our listeners to remember about health savings?
Well,
accounts?
Obviously, the first thing you want to remember, as long as it's for medical purposes, you're talking about not paying any taxes on that money. Essentially, that's what it is, because it goes in tax-free, it comes out tax-free, right? And it grows tax-free while you're waiting. So that's takeaway number one. Number two is don't treat this as just another investment tool, because it's not. You really have to, in your mind, say, okay, I'm 40 years old. I'm going to retire in 25 years. What's it going to look like if I just take $1,000 a month and start funding an HSA, right? Because if you think about it, in the future, that $1,000 a month could be worth, $3,000 a month. But now you've gotten ahead of the game and you've compounded in time with that. So now you'll have even more. And the even more part is important when we talk about health, our general health in retirement, because how can you enjoy your retirement if you don't have your health? So this is just a way to hedge for yourself and say, okay, now I don't have to worry about this. This is taken off the table. I think it's a very important takeaway, because you don't want to ever treat this like it's just, another investment tool. I mean, you'll have the benefit of being able to invest the money however you want, but the goal shouldn't be, all right, I'm investing this and this is what I'm going to buy my Ferrari with, right?
Yeah.
It should be kept in perspective. The perspective is, I never have to worry about medical costs again, right?
Fantastic. Adam, as always, great advice. Thank you for breaking that down for everybody, especially me. I had a lot of questions on that and really sharing some valuable insight and strategies with us today. We really appreciate it.
Sure. Yeah. And I think you mentioned cases, because it's really interesting. We've seen a lot of families, specifically cases when we talk about this, it just happens so often. And it's not just the insurance problem. And we've all heard the story. We're on Medicare already. Now, all of a sudden, our medication is costing us this much money if we don't use a generic brand. And some of these medications that are so much newer don't have a generic brand. So now you're looking at a $2,000 a month prescription bill, right? And that can be daunting, whether you have $100,000 or $10 million in your retirement savings. So $2,000 a month is a lot of money. Well, what would you have normally paid? $100 for the copay? Well, now there's $1,900 sitting in the HSA account. Let's say you have to do that the whole year. Eventually, you'll find a generic prescription for it. So this whole idea of prescription drugs is very, very important to remember, because not a lot of us think about this. But, as the medical world kind of grows and all these new discoveries are made, we know that the pharmaceutical industry they're the biggest crooks on the planet, right? They're going to get as much money as they can. Yeah. So this is also a tool that you can use against them, because again, if you're in retirement and you still have $30,000 or $40,000 left in your HSA, well, let me put some of that money towards, some prescription costs that have gone up. So that's also the key, I think. And that helps us just, build a better sense of health in our retirement, because everybody, at the end of the day, everybody's got to take a pill for something. Eventually, you got to take a pill for something.
Yesterday we had our lunch and learn, and we had our guest speaker, Chris Slight, there, and he did a health and wellness, if you will, health and wellness with your financial portfolio, but also for yourself,
Right.
And he took the time, to really, he talked about big pharma a little bit, but, just staying away from those pills, sometimes, and the synthetics, the synthetics, if you will.
Yeah.
And, I really appreciated him being so open about everything. He had such a great, great presentation. He's such a great speaker.
He really did. And I think the point of all of that was, and I think he ended with this as well, how can you possibly enjoy your retirement if you're not healthy? And more to it than that. We spend so much time on our financial health, right? If you've done a really good job, you've saved so much for retirement. There's certain times when we look at our accounts and we see all the money and we can say, well, I'm Superman. And you're not even thinking about the fact that you're also human. So that money's only good as long as you're alive. And we don't take an active, we don't take an active role in our health. We take a preventative role.
And
right?
Health, that means spiritual health, mental health, physical health, emotional health, all of those things.
Correct. Yeah. And I just think it's so important. He hit it out of the park and I've heard him talk about that before, in a sense that we're talking about professionals like us that, we want to be able to serve our clients as best as we can and serve our families. And if we aren't getting out and moving and doing some things to stay healthy, how much good are we going to be? It's that old adage, like if you want to, you got to put your oxygen mask on first before you take care of it.
You talked a lot about what your why is.
Right.
Why do you get out of bed in the morning? Do you wake up with intention? And I thought that was so moving, It
really was. And I think that the why is a really hard thing for a lot of our families to really think about, because their why was saving up enough money to retire one day.
Right. And working all those years to
spending 40 years on your why. And now all of a sudden you're backed off and you're saying, okay, what's my why now?
Yeah.
Right. Because we're here. So what do we do next? I think it's absolutely excellent advice. You got anything else, or are we running out of here? I think
that we covered quite a bit today. Just keep this HSA in your financial toolbox and it can help you achieve some of your goals, But stay tuned for our next episode 54.
54.
I think we're going to have a special guest speaker on that one.
Oh, that'll be nice.
Yeah.
Do I still have to be here?
You do.
Oh, okay. Just checking.
Because it is the Adam and Lauren. And I know that you're technically, the host. I'm the co-host. So that's why I get to.
I'm not the host. You're supposed to be the host, and I'm the co-host.
Well,
you're supposed to keep me
I keep you in.
Here.
I do. I keep you in line. Absolutely.
Well, all right, folks. That'll do it for this episode. I shouldn't say this week. That'll do it for this episode. And we're really looking forward to coming at you next time with some even better tools and strategies and another wrench to put in the toolbox, if you will. So until we see you again, be safe, take care of each other out there, and election season's coming up. So buckle everything down and get ready for the storm.
Yes.
There should be another S at the beginning of that storm, because it's going to be a storm.
Yeah.
Anyway, stay safe. God bless you all. Have a great week.
Bye-bye.
Investment advisory services are offered through Evolution Wealth Management Incorporated, an investment advisor registered with the state of Florida. Registration does not imply any level of skill or training. Evolution Wealth Management's unique CRD number is 307644. You can obtain a copy of Evolution Wealth Management's firm brochure, Form ADV Part 2A, free of charge by visiting advisorinfo.sec.gov. Evolution Wealth Management offers investment advisory services only, where it is appropriately registered or exempt from registration, and only after clients have entered into an investment advisory agreement confirming the terms of engagement and have been provided a copy of the firm's ADV Part 2A. Insurance services are provided by Evolution Retirement Services. Any guarantees mentioned are backed by the financial strength and claims paying ability of the issuing insurance company and may be subject to restrictions, limitations, or early withdrawal fees, which vary by the issuer. They do not refer in any way to securities or investment advisory products. You should consider the charges, risks, expense, and investment objectives carefully before entering a contract. This material has been prepared for informational purposes only and should not be construed as a solicitation to affect or attempt to affect either transactions in securities or the rendering of personalized investment advice. This material is not intended to provide and should not be relied on for tax, legal, accounting, or other financial advice. Evolution Wealth Management and Evolution Retirement Services do not provide tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Evolution Wealth Management and Evolution Retirement Services are affiliated entities.